So in this video, I want to share with you what a home equity line of credit is. They call it a HELOC, how they work, how you qualify for them, and what you can actually use these home equity lines of credit for. So to understand a home equity line of credit, the first thing I have to explain is home equity. Home equity is simply the difference between your home value and what you owe on your mortgage. So let's say you have your house and this home is worth $500,000. And let's say you have a mortgage and that mortgage is $300,000. So equity is simply the difference between the value of the home and what you owe on the mortgage. So in this example, you would have $200,000 of equity in your home. No bank is going to let you take this full $200,000. They're going to want to make sure you have some left over. So most banks, if we were to look at this home as the total equity, this is $500,000 up here and this is zero. You have your mortgage at $300,000. So you have all of this equity right here. The bank will typically let you go up to 90 or even 95%. If it's your primary residence, they'll let you go up to 90 or 95% of the value. So what that means is you take your value of $500,000 times 90%. That's going to be a balance of $450,000. So they'll let you have a first mortgage and a second mortgage for up to $450,000. So you take the $450, subtract your $300,000 mortgage that you have. So that means you could get up to $150,000 total loan or an equity line of credit. Now let's say you're like, Pete, I don't need $150,000. Why would I go up to $150,000? The beautiful thing about a HELOC is that you don't have to use all of the money. Well, this line of credit will work exactly like a credit card. So imagine a credit card where they let you borrow up to $150,000 and you can start with a zero balance. So that's a really large credit limit that a credit card company will give you. Well, number one, credit card companies, they're going to be at like 25, 26, 27% interest if they were even to give you the $150,000. I'm going to get into interest rates here in a second, but on this example, the payment that you make is only based on the balance that you have. So you could get a line of credit, you could have a zero balance, and so you wouldn't have any monthly payments, but you'd have a blank check that you could write up to $150,000 for anything that you wanted to do. Maybe you wanted to buy another investment property, or maybe you want to use that equity to transfer into a new primary residence, or you could use this equity for a consolidation. Maybe you have some debt that you want to consolidate. I had a customer just last week that we closed on their equity line of credit. They had $35,000 of credit cards and they were paying $2,500 a month on this credit card debt. So we gave them a $55,000 equity line of credit. We went up to 90% of the value of their home. $35,000 of the $55,000 they used to pay off all the credit cards. Their new payment was only $270 a month and they saved over $2,000 per month on their cash flow. Not to mention, when they paid off all of those credit cards, their credit score significantly increased over 100 points. So that's one example of what you could use this equity line of credit for. Most equity lines of credit require you to make an interest-only payment. And what this means is you're only paying the interest. You're not paying down the principal amount, and your balance isn't going up either. Your balance is staying exactly the same every single month. Of course, they allow you to pay down the balance quicker because it's just like a credit card. So of course you could pay it off, you could pay it down, or you could just make the minimum payment, which is the interest only payment. Let's say you took the full $150,000 line of credit, and let's say your interest rate was 9%. Well, that payment for the year, the interest only, will be $13,500. You take $13,500 and divide that by 12 months, and you get a monthly payment of $1,125 per month. Now, this is based on $150,000. Let's say you only take $30,000 instead of the $150,000. On $30,000, you take $30,000 times the 9%, and that gives you $2,700 for the year that you would pay in interest. This is the interest-only payment. $2,700 divided by 12 months. Your payment would only be $225 per month if you took $30,000. Now, with these lines of credit, you could pay it off as soon as you want or as fast as you like. So you could pay it down to zero. And then, of course, you don't have any monthly payments at all. When it comes to picking your interest rate, you could pick either a variable interest rate or you could do a fixed rate option. Now, if you got a variable interest rate, the variable is based on the prime, and you can look up the prime rate by simply going to Google and punching in what is the prime rate. The prime rate right now is about 7.5%. And depending on the company and who you get your equity line with, it's going to be prime plus 1% or maybe 2%. It's going to be prime plus a certain percentage. And that certain percentage depends on either the credit score, maybe how much equity you have in your home, or the occupancy, whether it's your primary residence, a second home, or investment property. The nice thing about the variable interest rate is prime is directly affected by the federal funds rate, the Fed funds rate. And this is the rate that the feds come out almost every month and decide whether to increase rates or to lower rates. Now, we're in March of 2025, and the last 6 to 9 months, they've lowered the federal funds rate by about 100 basis points from where it was. Everyone that has had an equity line that's on a variable rate, their interest rates have been coming down and their payments have been getting better. And this year, they're projected to lower the federal funds rate another 50 basis points. And so the equity lines are projected to have lower interest rates when the feds do drop that federal funds rate. Of course, you could decide to get a fixed interest rate, and typically on a fixed mortgage, it's anywhere from 1 or 2% higher than what you would typically get on a variable interest rate. Depending on what your best situation is, you can pick either a fixed or a variable interest rate on your home equity line of credit. If you were to get the home equity line of credit, they allow you to use that HELOC for anywhere from 3, 5, or 10 years. What this means is that you can use it like a credit card from 3, 5, or 10 years. Ask the bank how long the draw period is for. Most equity lines of credit are going to be anywhere from 3-year draw period or a 5-year draw period. After this 3 years or 5 years is up, you no longer can use it like a credit card, and you still can make the interest only payments. You just won't be able to use the extra equity that you have in the home. Some banks will allow you to go up to 10 years to be able to use this like a credit card. The interest only payments don't last for forever. They allow you typically to go up to 5 or maybe 10 years by paying it interest only. After this 5 or 10 year period, multiple things can happen, and you want to check the terms of the equity line. One of the things that could happen is they could say, hey, there's a balloon payment. A balloon payment simply means that after maybe 10 years or 15 years, they want the entire balance paid off and closed. Now, I wouldn't get too worried about a balloon payment because A, there's a lot of time in between, and B, instead of paying this off with what you have in your bank account, you could refinance this equity line of credit, pay it off before the balloon payment comes due. A balloon payment simply means that they want the entire balance paid off at that moment in time. Some of these equity lines will have a 10-year, maybe a 15-year balloon payment that they want this entire equity line paid off with the full balance. To qualify for a HELOC or a HE loan, it's just like a regular mortgage. They're going to want to look at your income and make sure you can qualify for both your first mortgage and this equity line of credit and any other debts that you may have, maybe car payments, etc. If you're a W-2 employee, they're going to go off your W-2s and pay stubs. They're going to look at your income from your employer. If you're self-employed, then you can either use tax returns to qualify, and typically they'll use the last 2 years of your tax returns, or if you have a lot of expenses and you don't show a lot of income on your taxes, as typically normal for a self-employed borrower, you can then use bank statements, and we'll go off of the bank statement deposits to qualify you for your monthly income. If you're thinking about getting an equity line of credit, I'm licensed in multiple different states across the country. I would love to help you. Reach out. Thank you so much, and we'll talk to you very soon. See ya.